Hey everyone, welcome back to Corporate Decoder, the place where we decode the not-so-secret secrets of the corporate world, and today we're diving into InPoint Commercial Real Estate Income Inc.'s latest filing. Prepare yourselves for some numbers that might make you do a double take, like a surprise dividend announcement but with more spreadsheets. Also, if you're into cutting through the corporate jargon and getting straight to the good stuff, make sure you're subscribed to the channel and join our Discord community link down below to keep the conversation going. This filing, an 8K, is like a company's urgent bulletin announcing big news. It's not a regular checkup. It's more of an emergency alert. Something significant has happened. In this case, the big news is the company is sharing its net asset value, or NAV, for July 2025. Think of NAV as the company's true worth if you sold everything it owned and paid off all its debts. It's a snapshot of their financial health. So let's get to the heart of it. What are these numbers telling us? As of July 31, 2025, the total value of the company's assets minus its liabilities, what they call net asset value, is a cool $163 million. That's the total worth. Now, if you own a piece of this company, you'll want to know how that $163 million is divided up. There are 10,118,000 shares of common stock out there, and dividing the total net asset value by the number of shares gives us the NAV per share. And that number, the NAV per share, is 1,062. This is the estimated value of each individual share of common stock. It's important to remember this is an estimate based on the value of their assets on a specific day, not necessarily what you could sell your shares for on the stock market. Let's peek behind those curtains and see what makes up this NAV. The biggest chunk of their holdings by far is in commercial mortgage loans. They have a massive $442 million tied up in these loans. This means they essentially function as a bank, lending money to businesses for their properties. Then there's $102 million in real estate owned. This could be properties they took back because of defaulted loans or properties they acquired for investment. It's good they have these assets, but it also ties up a lot of capital. Now, here's where things get a bit more complex and potentially risky. They have $283 million in repurchase agreements related to their commercial mortgage loans. A repurchase agreement for a repo is basically a short-term loan where they use their mortgage loans as collateral. Imagine pawning your valuable assets to get quick cash. While common in finance, it can add leverage and risk, especially if the value of the collateral drops or if they can't repurchase them. Diving deeper, we can see how the NAV breaks down across different classes of shares. For example, Class P shares have a NAV per share of $16.1038, while Class T shares are valued slightly higher at $16 in dolly, higher at $16.108648 per shares. That perhaps the costs associated with different share classes like fees or specific distributions are being accounted for, leading to these minor variations in their per share value. They also have to pay interest on their borrowings, and in July they had $2.4 million in interest payable. This is a direct cost of doing business when you use debt to finance your assets. There are also accrued stockholder servicing fees, which are fees paid to brokers who help manage and service shareholder accounts. For Class T and Class D shares, they recorded $645,000 in accrued fees. This is a normal operating expense for a company that raises money through share sales. Looking at the breakdown of NAV per share for each class, like Class P shares having an NAV of $16.238, it shows us that the company's management is calculating the value of each share class separately. This is important for investors who hold different classes of stock, as it reflects the specific economic characteristics tied to each share type. For Class P shares, there are 8,563,000 shares outstanding. This is the largest chunk of their common stock, so when we see the YEV per share for Class P, it has a significant impact on the overall picture. Class A shares, on the other hand, have an EV per share of 16.5064 cents with 746,000 shares outstanding. The slight difference in EV per share compared to Class P suggests there might be different fee structures or asset allocations impacting these share classes. We also see that Class T shares have an MFIF per share of $16.84. These shares are valued a bit higher than Class P and Class A. This premium might be due to various factors we can't see directly in this filing, like specific investor agreements or how the shares were issued. Interestingly, there are no Class S shares outstanding as of July 31, 2025, and therefore no NAV is reported for them. This indicates that either sales for this class were minimal or had not yet commenced in a way that warranted reporting. Class D shares have an EV per share of 16.177 with 48,000 shares outstanding. This is another distinct value for a specific class, highlighting the complex structure of their shareholder base. Finally, Class I shares have an M56, 7, 1567 chovens, and 471,000 shares are outstanding. It's pretty common for companies to offer different share classes to cater to different types of investors, each with its own set of fees and benefits. This granularity in reporting is essential for transparency. When we look at the total net asset value attributable to common stock, which is $1,633 million, we see that most of it is tied up in commercial mortgage loans and real estate. This tells us that their business is very much dependent on the performance of the real estate market and the ability of borrowers to repay their loans. A significant liability that reduces the net asset value available to common stockholders is the preferred stock. In this case, they have $88.3 million in preferred stock. Preferred stockholders have a claim on the company's assets and earnings that is senior to common stockholders. So while the company might have a large asset base, a big portion of its value is already earmarked for preferred shareholders. They also have about $38 million in cash and cash equivalents. This is the liquid money readily available to cover expenses or seize investment opportunities. It's a healthy amount, providing some short-term stability. The company is emphasizing that it suspended the sale of shares in its public offering back in January 2023. This is a crucial piece of information. It means the growth in their share base is likely limited to distributions being reinvested rather than new money coming in from new investors buying shares directly. This can impact how they fund new investments and how their DAV per share might change over time due to dilution or lack thereof. Overall, InPoint Commercial Real Estate Income Inc. is playing the long game in the commercial real estate market. They are a lender essentially, relying heavily on mortgage loans and owned real estate. Their NAV per share of over 16 is the headline number. But what's more interesting is the composition of that value. A big chunk is in mortgages, which can be great when things are good, but risky if borrowers default or if interest rates make those loans less valuable. The repurchase agreements are a red flag for those who like simpler investments, as they introduce leverage and short-term funding needs that can amplify losses in tough times. The fact that they've suspended new share sales means their growth will be more organic, driven by performance rather than fresh capital injections. This can be a sign of confidence in their existing assets or a sign that market conditions aren't favorable for raising more capital. The differences in IFA per share of over 16 are to if I'm foregoing. To their differences in IVAs per share across the classes are subtle, but suggest a layered approach to investor types. Ultimately, their success hinges on. Alright, that's a breakdown of InPoint Commercial Real Estate Income Inc.'s latest filing. What's your take on these numbers and what they signal for the company's future? Do those repurchase agreements make you nervous, or are they just standard practice? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps the channel, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord link in the description to join our community. Thanks for watching. See you next time.